Markets move fast. Get the insights you need in 10 minutes with Barclays Brief, a podcast from Barclays Investment Bank. Each week, our experts analyze market themes, helping you anticipate what's next. Listen to Barclays Brief, wherever you get your podcasts.
Bloomberg Audio Studios. Podcasts, radio, news.
This is a breaking news update from Bloomberg. Instant reaction and analysis from our 3,000 journalists and analysts around the world.
The beginning of a walk into the sunset for the chairman of the Federal Reserve. Jay Powell only has 2 more of these meetings on the calendar as the chairman of the world's most important central bank. For the equity market on the S&P 500, still close to all-time highs on the S&P. On the Nasdaq 100, up by 0.5. In the bond market, on 2s, 10s and 30s, we look like this. Yields just about unchanged. Your 10-year, 425. Your 2-year, 358. Journalists did their best to make this one interesting. Chairman Powell was determined to make it boring. Take a listen to what the chairman had to say.
Some people did want to cut and dissented, but committee pretty broadly for holding today. We still have some tension between employment and inflation, but it's less than it was. I think that the upside risks to inflation and the downside risks to inflation have probably both diminished a bit. So, we'll be looking at that. There are different views on the committee, and, we'll find our way forward as the data evolve.
TK, just my takeaway, just my observation. Towards the end, it felt like a man who was looking forward to retiring and stepping down.
There was a gold question. It's great. He doesn't have Krugerrands in the drawer. He's got the Jerry Garcia commemorative gold coins in the drawer. So way looser. There's no question about that. But it was really interesting to see the nuances of the market, away from the things we usually quote, folks, to look at what sterling was doing, the way euro was vibrating in that. And I would suggest they can go back and say, we got through that in one piece.
He's got some advice for the next Fed chair. Stay out of politics. Stephanie Roth of Wolf Research joins us now for more. Stephanie, the questions loaded with politics. He was not engaging. He was not playing. What was the takeaway for you?
Yeah, I think it's a Fed that is comfortable with the backdrop of data, which I think is the right call. The data seem to be improving from here. We actually think that it will continue to get better, in which case this will certainly be the last cut under Chair Powell. There's no more cuts under Chair Powell. He's done. And I think that's right. He's fading into the sunset and just wants to avoid all of the questions that he didn't really want to answer.
Unfair question, but I can save it for your morning note at Wolf Research. Maybe it'll help. You think Mark Carney at Davos talking about the new geometry of middle countries. You look at the president, neo-mercantilism, the president weak dollar. Did the Secretary of Treasury save this press conference by coming out hours before and sounding like James Baker from Another Time and Place on strong dollar?
Yeah, last night it was getting to be a little bit concerning when Trump made the comments regarding his comfort around the sharp drop in the dollar that we've seen. That could also have reverberations throughout the rest of the market. So I think that is fair to some extent. Powell clearly didn't want to comment on the dollar regardless. Right. But there was the legitimate risk, and there still is, that there could become reverberations as the carry trade unwinds. But it seems that Bessent is very well aware of the aftermath of that.
Can I ask economic questions?
Please go for it. This is the appropriate forum.
Anna Wong has been great on this, as you have as well, Stephanie Roth, where the idea the vector on goods we take for granted is disinflation. That's turned around. Now we've got goods moving up. We've got gold, copper, and all the other stuff John's talking about. Do you just assume out there somewhere after stimulus that goods roll over again into some form of disinflation, even if service sector stays with an inflationary tone?
Yeah, we're probably going to see a backdrop where we're likely to have some firm goods prices in the next couple of months, in the sense that, one, you tend to have, there's some seasonal issues in some of the data. You have consumer stimulus that's going to hit goods prices for the next quarter or so. And then beyond that, you're going to move to an environment where goods are running at roughly 0% year over year. And then it's back to an environment where it's all about the service sector.
Away from the politics of Washington, one of the takeaways from that particular news conference that I have is something I've heard repeatedly from a lot of Wall Street participants, market participants, is that the data is going to be better. It will improve. The chairman's saying overall it's a stronger forecast than in December. The data since the last meeting show clear growth improvement. And a lot of people think that's going to continue because of the tax refunds. How important are these tax refunds going to be? Do you think people are overly optimistic about the impact this might have?
I think they will be positive for the consumer, but this is a consumer that is already doing fairly well. Spending has been fairly solid in the fourth quarter, and everyone's revised up their GDP numbers in the fourth quarter. Q1 should be equally pretty solid. I think the main takeaway is that, maybe even you do get a bit of a bump in consumer spending. People will spend the stimulus checks that come to them. That is the American consumer. But then beyond that, this is an environment where you have positive momentum in the economy. So I think it will be important. That's entirely fair. But it's also an economy that's performing a lot better than many expected towards the back part of the year. Last year, when everyone was concerned about the health of the consumer, which was entirely
A journalist
overdone.
in the news conference asked the question, why wouldn't that lead to higher inflation, given how in some parts of this economy we are supply constrained? What's the answer to that?
The answer is that you'll see some sticky inflation through the first part of the year, in which case the next Fed chair is going to be in an environment where inflation is running roughly 3%, the economy is fairly firm, and they're going to be trying to cut interest rates, and they're probably going to have trouble at first. It's going to be later in the year when inflation starts to cool again. You lose a little bit of that momentum where it becomes a little bit easier of a conversation.
I haven't asked anyone this question. I think it's fair to ask now after this press conference. We talked about, and the president with great negativity would talk about the Biden stimulus. What does the Trump stimulus actually look like into the midterm elections?
Well, you'll see that better consumer for the first part of the year. It will fade into the election period of time, in which case then the focus is going to continue to be on affordability. So that's the opposite of stimulus from a sentiment perspective. And this is going to be the biggest challenge for the administration they're going to be dealing with all year, and they're going to have a lot of trouble. They've been throwing a lot of different things at the wall to see what will stick, and there is not that much they can do to change.
There's nothing sticking right now, but any given central bank, whether it's Chairman Waller, Chairman Miran, whoever, Chairman Ferro, whatever we see with the central bank, they've got to figure out what will stick with half of America flat on their back. What's the Wolf Research plan for that, besides a check in the mail?
There is not that much can be done. The one positive is not about anything the administration can do. It is just a cyclical pickup in the economy that will help at the margin for a lot of the bottom end of the K who has been left out. They've been left out for a whole host of reasons.
This is what Orzag and Posen are saying is, you get a pickup in the economy, you get productivity, and it pulls up people. I mean, that's the reigning theory here, John, into Labor Day and into the end of the year.
Just on the next Fed chair, this from the Treasury Secretary in the last hour or so, speaking to Yahoo, saying the pick may come in a week or so. It just feels like a rolling week at the moment. We're waiting another week to get that Fed chair pick. If you're just joining us, we're live on Bloomberg TV and on Bloomberg Radio. A Fed rate decision behind us, a decision to keep rates unchanged after cutting at 3 consecutive meetings. We did get some dissent from 2 Fed governors, one being Governor Waller, the other being Governor Miran, looking for a 25 basis point reduction. Let's get to Michael McKee, who was in that news conference with Chairman Powell. Mike, welcome back. I give you an A for trying, a big A for trying. What was your takeaway from the chairman moments ago?
Well, I think we got the answer to whether Jay Powell would talk politics or policy. He focused on policy, tried to stay away as much as possible from politics. When I asked him, and Nick Timmeros from the Wall Street Journal asked him, and then he was asked about the dollar, all three of us got sort of the Seinfeld answer. No soup for you. He's not going to talk about that issue right now. In terms of policy, however, he seemed to be a little bit stronger on the outlook for the economy than his feelings about what rates would be doing. He didn't give us any indication that rates would be going down, but he didn't give us any indication that they think they're at neutral. He suggested we're at the high end of it, which would leave you open to a rate cut if you were able to. In other words, if inflation's going down and unemployment calls for it. But as Stephanie was saying, inflation is going to stay elevated for a while. So it's going to be hard in the remainder of Powell's term to have any rate cuts. And it'd be hard for somebody new coming in to get rate cuts right in the beginning, even if, as Powell says, they think that inflation ex tariffs is running just about 2% or a little above.
On the committee, Mike, there is still a push for an interest rate reduction from both Governor Miran and Governor Waller. Mike, for the people that missed your coverage a little bit earlier, immediately following the decision, what's the rationale for that push from those 2 governors on this FOMC?
Well, we know Miran has sort of been ordered to dissent. It's interesting that he only dissented for 25 basis points this time instead of for 50. Either he thinks they've gone far enough or he didn't need to do 50 to keep the president's favor. For Chris Waller, the initial reaction I've seen from just about everybody who has written about it is that he's trying to keep his place in line for a possible promotion to Fed chair, replacing Powell. But I would imagine also that Waller, knowing him and knowing his reputation, will probably come out on Friday when the blackout lifts and give us some sort of statement on the economic reasons why he thinks a cut is important at this time. It's a little bit different situation now because the unemployment rate has gone down. Inflation is, according to the Fed's calculations, which Powell talked about, going to, for the core PCE, hit 3%. So it's harder to make the case for a cut at the moment. So it'll be interesting to see what Waller has to say.
Mike McKee, thank you, sir. Stay close. We'll come back to you a little bit later in the programme. We talked about this in the immediate aftermath of the decision, that dissent from Governor Waller for a 25 basis point reduction. We heard from former Vice Chair Richard Clarida, from Torsten Slok of Apollo, essentially calling it unfair to characterise this as a man purely voting for a reduction to keep his name in the running to become the Fed chair.
Yeah.
That has been a man who's delivered effective leadership, thought leadership at the Federal Reserve, and caught every single turn of the economy over the last several years.
Yeah, I think Torsten summed it up nicely. This is a legit academic, folks, with major cred out at Washington State. He wrote a very important, small, tiny, perfect paper in 1991, I believe it was. It made his reputation. And it's on game theory, but accessible game theory. Besides, he's like you. He's cut and chiseled. He's lifting weights every day.
I wish I lifted like he did. Have you seen him deadlift?
Oh, yeah.
Have you seen these? It's ridiculous.
Yeah.
It's ridiculous how much weight he lifts. But yes, please continue.
He's a legitimate guy. I mean, Ken Rogo's a huge fan of what this academic has done, and he's delivered it. And here's the key thing, and I think attractive to the president. He's done it in a plain-spoken way. And that may be to the benefit of President Trump.
I want to avoid the politics of this, Tom, but we've complained so much about groupthink at the Federal Reserve. We can't complain when someone sticks their neck out and says we need to do something different, and this is why I think we need to do this differently. Risk cut both ways. And we've seen that coming out of the pandemic, how wrong the consensus has been.
Oh, yeah.
Risk cuts both ways.
Humility is in order, and frankly, I heard that from Chairman Powell today.
Jeffrey Rosenberg of BlackRock joins us now to weigh in on all of this. Jeff, welcome to the show, sir. The big takeaway for you, unchanged, and a chairman who's not looking to change things for the next several months. Would you agree?
Yeah, I think the big takeaway on the policy side was the removal of the balance of risks from the labor market assessment. He got asked that question. I think the most interesting interchange was in the very first question, where he very clearly laid out he wasn't going to address the politics side and got into the substance on the change of the balance of risks. And I think from the economic perspective, that was the most interesting thing in acknowledging that they've moved away from both sides of the inflation and the labor market tension that was there previously. And that's an upgrade to the assessment. I think the near-term, implication is the bond market has the pricing right that, in the next 6 months, there's really no real movement towards a cut. Now, obviously, it depends on the data, and everything in terms of the expectations for the FOMC is going to be in the back half of the year.
Jeff Rosenberg, maybe more important in the press conference is the American exceptionalism at 402 Microsoft, 403 Tesla, 405 Meta, 408 IBM. Hani, thank you so much for those times. I mean, what's keeping this Fed going is this exceptional America. How do they keep that experiment going with their policy given politics?
Yeah, that's a really important point, Tom. And it came up a little bit in the press conference. You just had to listen for it. It's a point I've made often, in these discussions that, where is the surprise coming from? It's coming from the consumption side. It's being supported by the wealth effect, and the wealth effect is being supported by all of those earnings and that AI story. So, we talk a lot about the macroeconomic perspective here, but it's really about the micro, and the micro is the AI and the technology story, the concentration, and it's flowing through from the micro to the macro through the wealth effect. And that was why most economists are underclubbing growth in 2025. It may be, again, the story in 2026. It's a little bit of the K-shaped economy story as well, because it's only a small portion that are benefiting, but that small portion overwhelmingly is influencing that consumption
Stephanie
side.
Roth, I look at that. I love how Mr. Rosenberg goes to the wealth effect as well. I want to frame out what we talked to Torsten Slok about. Real GDP which is being buoyant by the wealth effect, maybe with a little bit of add-on inflation. Where do you see nominal GDP for the next chairman? John, we go out 2 meetings, then there's like 1 or 2 or 3 meetings. October 29 is a dead meeting because of the election. Where's nominal Labor Day-ish in America? Yeah,
you're going to be sitting 5%, a little bit higher.
Wealth effect, John. That's what we call this. Rosenberg's right.
Yeah, I mean, and the wealth effect has been really important for the past couple of years, partially just because it has broadened out beyond just the very wealthy. This is a consumer where younger people are involved in equities, more people, even though they don't have the lion's share of the equities, they are still more invested than many years past. So it's helping a big part of America, of course, not that bottom of the K, which just continues.
And yet by some measures, Conference Board, consumer confidence hasn't been lower in the last decade. Explain.
Yeah, Conference Board was weaker, UMich was stronger. I think the net of the two is a consumer that feels bad about the price level in the economy, which is something that cannot be changed easily by any means. But they're largely employed and they don't like the policy uncertainty. So they continue to spend because most of them are employed and continue to make decent wage gains. They also have they benefit from that wealth effect. But when you ask them, how do you feel about the economy, it's perhaps not great.
Or maybe 4 or 5% nominal GDP is not what it used to be, that it's not as labor intensive, that this growth is coming from tech capex spend that not changing the lives of everyday Americans, at least not now. Isn't that a good explanation as to what's going on?
Yeah, I think that's part of it. And also concerned about the future prospects, because we all know AI is going to have important impacts on the labor market. You continue to see headlines about job cuts. The thing is, at this part of the year, there is often headlines about job cuts, and everybody gets scared in January about the labor market because they see all these headlines, and then it proves to be not such a big problem.
Jeff Rosenberg, I'm sure you're aware of Posen and Orszag's mapping out of a higher inflation, a more resilient inflation. What does your bond world do if we get inflation resilience?
So a big part of that, Tom, is in the term premium, right? The Fed and what we saw in 2025 was that the short end of the yield curve, shorter maturities were very responsive to policy rates. It came up in the press conference today in the question about long-term interest rates. And Powell basically admitted that, longer-term interest rates are going to be a function. He focused on the fiscal policy uncertainty, but there's more than that. There's real interest rates. The whole other picture to AI is an incredible shift in investment demand. That raises real interest rates. And the inflation piece to your question, Tom, is about inflation risk premia. And as you move further out in time, there's more time for that uncertainty for all those reasons to affect inflation. And the bond market impact is a steeper yield curve reflective in nominal space of greater inflation risk premium.
I mean, I look at this, Jeff, and the question of where we are, and this goes back to dollar analysis of the last couple days, is it's very nonlinear at some point. If I look, to look at the benchmark 10-year yield, how close are we to a point where you get accelerative tendencies? If we unwind, that would be lower bond prices, higher yield. Is it 10 beeps away? Is it 30 beeps away? Is it a fiction? It's just out there somewhere.
Yeah, again, it kind of came up in the context of the recent volatility in JGBs. Is there a nonlinear event for the U.S. bond market? It's a different market. It's much bigger. It's much deeper. There's a lot more impact in terms of price and substitution effects that can happen. He talked about it in terms of the fiscal side. The debt level is sustainable, but the path is unsustainable. At some point, no one really knows where that point is. We used to talk about it in the context of small open market economies, around 100%, 80% debt to GDP. That's a very different setup than for the U.S. economy, and we don't really know. I think it's a much longer term process in terms of building a risk premia slowly and less of this kind of tipping point argument. But we don't really know for the U.S. bond market what that will look like.
Jeff, I'll ask you a direct question. I asked this to Torsten Slok of Apollo in the last hour, and he said no. Do you have a decent understanding now of this Fed's reaction function?
I don't know if it's as clear as no. I think that they shifted in the summer. And Waller was ahead of it with regards to the payroll side, the labor market side. They were validated in that shift by the slowdown in the labor market. And they told us today that slowdown market in the labor market is kind of stabilized. So if you look at the response function, at least for consistency, they paused the cutting, and they appears to be justified by the reduction in the downside risk to the labor market. So to me, that kind of validates a little bit of what we understand about their response function of this current Fed, that they are more keyed in on the labor market risks than they are on the growth side. And the growth side is being upgraded at the same time. He talked a little bit about that. So I think we're still getting, some view into that response.
Well, let me put it another way. Let's say growth picks up in the way that Stephanie and Torsten are looking for. And let's say inflation picks up alongside that. Do you have an understanding of what they will or won't do later this year?
Well, he kind of answered that one as well, at least from Powell's perspective, is that no one has, trying to find my notes on this one, no one has rate hikes in the expectation. The economics of an uptick in growth and an uptick in inflation, might otherwise say that. But yes, in terms of the response function, it's still asymmetric here, where they're looking, to be stable, or maybe looking for economic reasons to cut, but not looking for an economic scenario where they're raising interest rates.
And folks, I really want to say to have Jeffrey Rosenberg here with Stephanie Roth is important, because they both carry their day-to-day work with a lot of humility. Where in your head is the unemployment rate where everyone involved goes, oops, it's not 4.6, 4.7 or that? Is there a Stephanie Roth unemployment rate where the dialogue radically changes if we get that?
Yeah, if you start to shift towards 5%, then the dynamics... Good
round number, 5%.
Good round number, 5%.
Is that 5% now the same as it was a 5% 10 or 30 years ago? I don't think it is.
No, I don't think so either.
In what way? Describe to our audiences here worldwide why a 5% all-American unemployment rate now was 7% unemployment rate back when.
Yeah, it structurally shifted down over time. In which case, because the labor market dynamics have changed materially. What keeps us in full employment today is not the same as what we were. So therefore, if we're sitting at 5%, that's a much riskier environment than what it would have been.
John, you live this in Coventry with the auto business in the United Kingdom. I just watched the destruction of Eastman Kodak yesterday. Great YouTube video. It's like walking through my childhood. But that world is gone when it was a 7% unemployment. And now we're walking around happy with a 5% number.
Well, I think to build on that, Tom, I think we have to confront a new risk. You bring up the old manufacturing hubs, the basis of, say, the United Kingdom and, for that matter, Detroit here in the United States. That's what globalization did to manufacturing. And the risk now that we have to confront in the West, at least, is whether AI is going to do that to services, what globalization did to manufacturing. Do you think there was a brief acknowledgement there from the chairman in that news conference, just to give a little nod to the prospect of a reduction in jobs, at least in the short term, because of this new technology?
Yeah, I think that's fair. And I guess that is the risk in the future, that we end up with a structural shift higher. Because before it was, a backdrop where globalization and manufacturing helped to sort of bring the economy into, today we're a much more developed economy than we were, of course. That's the risk that we see into the future, that we end up with a structurally slightly higher unemployment rate. But I'm not convinced that it will end up being quite that. I think there's an environment where you end up with job gains as a result.
I think that's the problem being a policymaker right now. I'm not convinced of anything, and I'm not sure they are either. Things have changed. We asked Bob Michael at JP Morgan, your former colleague, the question a little bit earlier. What's more important for the outlook for the economy now? The spending numbers from these big names that report in about 20 minutes' time in the next hour, or the payrolls report that we get every first Friday of the month? And he's pointing to tech capex from the major tech players in the United States. That has completely changed the conversation. How do you set policy with traditional macro indicators when what's driving the economy right now is something else?
So I think what's driving markets is, of course, AI, and that kind of is required to continue moving ahead in order for the U.S. economy to be okay.
Right.
If tech capex started to slow down materially as a result of AI, there was for whatever reason, they decided the return on that investment wasn't quite as high, the U.S. economy would still be okay. We're not at a place where AI is so ingrained and important into the economy that if those dynamics were to change, the economy would be in big trouble. We estimate that the domestic share of CapEx of AI-related CapEx is at 1.5% of GDP. Housing is, a little over 3%, so it's not that ingrained yet. In a couple of years, if this continues at the pace, then the conversation is different.
Well, Jeff Rosenberg, let me ask you a Stephanie Roth question. I think it fits in here fine. And that is, if you look at the labor upset that's out there, John and I are overwhelmed every day with emails talking about fancy people at BlackRock and Wolf Research, talking about AI this, AI that. When does the central bank just have to address with these two Americas? When do they address two Americas?
It's a great conversation. It came up again in the press conference, and I think Powell did a really nice job in addressing what we don't really know, and we don't know what that impact is going to be. But he also critically added this comment on, this is not something that Fed policy is well suited to, right? So if we want to address labor market frictions and disruptions, that's much better suited to other government policies than the broad cudgel of monetary policy. I want to just come back to your earlier conversation and just make one other point, that the wealth effect that we were discussing, it's a double-edged sword. So while the CapEx impact that Stephanie was talking about, point well taken, the wealth effect, if you were to have, a challenge to the valuations or concerns or repricing, the benefits that we've seen can also, turn into headwinds. And so we should just be kind of aware of that fact of the AI micro impact to the macro economy.
Jeff, I just want to avoid the rant, but we have got a few more minutes. I get frustrated when we say things like the Fed can't do things about certain situations when they've contributed to them themselves. And I'm talking specifically about, say, inequality and the K-shaped economy. Jeff, haven't they contributed to that problem?
Yeah, it's one of my favorite discussions. And, it goes back, Jonathan, even in the comment that I just made, how does the Fed address these things in their policy framework? It's financial conditions. And the Fed does affect financial conditions, and they are affected by financial conditions. And so, when the Fed made a policy choice back in the GFC through the portfolio channel to try to address the challenges of the collapse in the housing market, they kind of pushed up into their transmission mechanism toolkit, transmission through financial conditions. And so that's really the problem that we've been inheriting for the last 2 decades. And so, yes, it is something that they're part of. It's part of Bessent's, criticism in the gain of function. And it's part of the kind of, future potential for Fed policy review of, how do we extract, or how does the institution extract itself from those things? At a simple level, it's what should the portfolio look like? What should the holdings look like? Should we still have mortgages? And that's one example of how you could, change some of those functions in a new policy setting.
Rant over. That's the challenge for the next guy. Jeff, it's good to see you. Jeffrey Rosenberg there of BlackRock.